Hey, what's going on, everybody? My name is Aaron. So getting started in the stock market can be a very difficult task, especially with so much differing and conflicting information available today. So in today's video, I'm going to break down step by step how to invest in the stock market for beginners. If you enjoyed the content, please leave a like on the video, subscribe to the channel, and let's get right into it. So we're going to break today's video down into three sections. We're going to start off with just getting started in the stock market. Then we're going to talk about how to actually pick stocks. And lastly, I'm going to share some investment strategies and some investing tips for you. Okay, so getting started. If you're already watching this video, you probably already understand to an extent the benefits of the investing process. After all, if you just held your money in cash, while it might initially seem safe, you're actually going to be losing money every year due to inflation. Now, inflation represents the devaluing of our dollars and our cash over time as more and more money is printed and added into circulation. Okay, so the best way to understand the investing process is to think about it in terms of different layers. So the very first layer, you just have the general world of investing. And then the second layer, you actually have the brokerage platform. The brokerage platform is what allows you to actually buy and sell shares. And then within your brokerage platform, you have different investing accounts, each one with different advantages and disadvantages. And then lastly, in layer number 4, you have the actual investments, the actual stocks that you purchase within that account. Okay, so before we buy stock, we see now that we need a brokerage. So the broker is like the middleman. It's the institution that you go through in order to purchase stock. So if you want to buy a particular stock, you have cash within your brokerage account. The broker will then use that cash to purchase shares of stock and in return give you ownership of that stock. And there are many different types of brokerages. You have M1 Finance, Charles Schwab, TD Ameritrade, Robinhood's a popular one. All of these are different brokerages or exchanges that allow you to buy stock. So I personally use Charles Schwab and M1 Finance. I find that Charles Schwab is fantastic for buying individual companies. If you just want to buy a couple stocks here and there, Charles Schwab has all the major functionality that you need. And then M1 Finance is also fantastic. With M1, you can create what's called pies, which is essentially a portfolio constructed of your own individual stocks, ETFs, all of which come together to form one investment portfolio. Okay, so you know about brokerages. Now let's talk about the actual accounts that you can open up within these brokerage platforms. So there are three main accounts we're going to talk about, and that's a traditional IRA, a Roth IRA, and then a standard taxable brokerage account. This is going to exclude a 401k. A 401k you would typically invest in through your employer, so that will be handled separately. So in order to understand the differences between these three different types of accounts, we're going to look at this very handy spreadsheet. So as you can see with a traditional IRA and a Roth IRA, there's a contribution limit every single year of $6,000, meaning you can't contribute any more than $6,000 into that account every single year. And then with the standard taxable account, you can contribute any amount, there's no limit. So next we're going to look at withdrawals. When you want to withdraw money from either a traditional or from a Roth IRA, you have to wait until you're age 59 and a half to withdraw any money without incurring a 10% penalty and taxes on that money. With a standard brokerage account, you can withdraw money at any time. Okay, so at this point, a standard brokerage account probably seems a bit better, considering you can put in as much money as you want, you can withdraw it whenever. Why would anyone use these IRAs? So the advantage of an IRA are the tax implications. So with a traditional IRA, any money you contribute into that IRA is then tax deductible at the end of that year. Meaning if you made $10,000, but you contributed $6,000 into a traditional IRA, you're only going to be taxed on $4,000 at the end of that tax year. However, when you want to withdraw money after age 59 and a half from a traditional IRA, you're going to have to then pay taxes on that money. So you get a tax break up front, but then down the line when you want to withdraw that money, you will have to pay taxes. A Roth IRA is the opposite. With a Roth IRA, all your contributions you're already going to have paid taxes on. However, when you then withdraw money from a Roth IRA, all those withdrawals are completely tax-free. Meaning if I contribute $6,000 in a given year, I can't write that off on my taxes. But if over the course of my 40 years of investing, that money has then grown to, let's say, $1 million or $1.5 million, when I start withdrawing that money, I won't be taxed on any of it. So if you're on the younger side, it definitely makes more sense to invest in a Roth IRA. The idea being that the taxes you're paying now as a younger person are going to be significantly less than they will be down the line when you're more developed in your career and you're making more money. Therefore, it makes more sense to pay taxes on your contributions now to then have tax-free withdrawals later down the line. And then if you're older and more defined in your career and you're already in a higher tax bracket, then it can make more sense for you to invest in a traditional IRA where you get that tax break every single year from those contributions. And then with the standard taxable brokerage account, there's no tax sheltering, meaning any capital gains or dividends you make within those accounts are going to be taxed in that calendar year. And then a quick note about IRAs, if you contribute $6,000 to a Roth IRA, you can't then also contribute to a traditional IRA. So it's one or the other. Okay, so we have this brokerage and we have this account to actually invest in, and now comes the fun part, filling up that account with stocks. So a stock represents partial ownership in a company. So if you own a couple shares of Apple stock, let's say, you are a fractional part owner of the company Apple. And if you owned all 17 billion shares that Apple has of stock outstanding, then you'd actually own Apple. But that would also make you a trillionaire, in which case you wouldn't be watching this video. However, if you are a trillionaire and you're watching this video, thank you, that's kind of awesome. Anyway, so if a stock represents ownership, then what's an ETF? So an ETF is an exchange-traded fund. And think of an ETF as taking a bunch of stocks, throwing them together in a basket, and then selling that basket to somebody. And by buying that basket, you're gaining exposure to all these individual stocks without having to buy them directly. Okay, so stocks are direct ownership in a company, and with ETFs, you can get exposure to a bunch of companies by owning them indirectly. So which should we own, stocks or ETFs? Well, a great thing to do is actually to own both stocks and ETFs. So ETFs are great because they're comprised of many, many different stocks, which give you that exposure, but it also makes them less risky as well as less volatile in price. And then you have individual stocks that could be more volatile in terms of moving up and moving down in price, but with individual stocks, you have the potential for those greater returns than you would ordinarily have by buying ETFs. So how do I actually pick stocks and ETFs? How do I choose between one and another? So it's actually simpler than you might think. So a great thing to do is start off with a couple just broad ETFs. So a great one to start off with is the S&P 500 ETF, which is comprised of the top 500 US companies. You could also then look into buying one or two industry-specific ETFs. So they make these ETFs for virtually anything. If you're passionate about clean energy, transportation, 3D printing, technology, anything, these ETFs are created and they're comprised of stocks that operate within that particular industry or that particular sector. So find some industry, some sector that resonates with you, buy an ETF specific to that industry, as well as some broad market S&P 500 general ETF. So then on top of owning those ETFs, it's also great then to buy some individual companies. So a great starting point is just purchasing companies that you understand well. Maybe you're into Lululemon, Apple, Microsoft, Peloton. These are all a bunch of different companies that maybe you interact with and you use their products quite frequently. So start off by buying into those companies because you have a great sense and understanding of those particular companies. And remember, you want to keep the amount of individual stocks you're buying relatively low. The goal of buying individual stocks, again, right here, is to get that concentrated investment portfolio. Okay, so lastly, number 3, investing strategies and some tips. So first tip, buying and holding. So for 95% of people watching this video, buying and holding is the best investment strategy you could possibly implement. And with buying and holding, what you're essentially doing is purchasing stock and you're planning on holding them for the long term, 10, 20, even 30 plus years. And if you look back throughout history, through all of the stock market crashes and all of its historic rises, you'll find that by simply buying and holding investments, the chances of being profitable increase astronomically. However, if you fall into the trap of trading stocks back and forth on a frequent basis, the chances that you'll lose money increase just as much. And then another common question is, how often should I invest? And the answer is really whenever you can. So every week, every month, maybe whenever you get paid, put a little bit of money over time into the market. And this is great because what you're doing is you're spreading your risk by buying a little bit of stock at different periods of time. So this beats what's called lump sum investing, where you take a huge lump sum of money and you throw it all into the market at once. And the problem there is that you got to time the market because you don't want to throw it all in when the market's at its very top. So again, by buying a little bit of stock consistently over the long term, you're not only going to be gaining yourself more exposure to the investing world, but you're going to be spreading your risk off because again, you're not investing a whole ton of money all at one single time. And then finally, my last bit of advice is to go out there and just get started. You know, in this day and age, so much money has been lost by people waiting on the sidelines, waiting to invest, either trying to time the next market crash or simply being too lazy to jump on the process of actually opening an account. The key is just to sit down and get out there and do it and open that investment portfolio, buy those couple of stocks, and your future self will thank you later. If you enjoyed today's video, please go ahead and give a like, subscribe to the channel, and I'll see you in the next one.